Now that we understand the box and we have a good idea of the pricing, remember the box is going to help us determine when we do our bull spread, hey, should I buy the call spread or should I sell the corresponding put spread? What should I do? Well, now you know. We look at our box. If the box is above the value, we're the credit trade, right? We're going to sell the put spread. If the box is below the value, we're going to buy the call spread. Simple as that. Let's take a look at how the bull spread works here. As the stock price and the volatility move and time goes by, the price differential between the two strikes increases. Why? Because the amount of extrinsic value between them disappears. And at expiration, all that's left is the intrinsic value. And the intrinsic value difference between 25 and 30 is $5. Between 90 and 100 is $10. So what happens is that this spread, the bull spread, as time goes by and extrinsic value leaves the equation at expiration, the only value left will be the intrinsic value of the two options. That is what happens. As the stock moves up, the value of my in-the-money call in my bull spread will increase faster than the value of my out-of-the-money call, thereby making me money. If I did the other bull spread, the credit one, selling the put spread, as the stock moves up, my higher strike put, the one I'm short, the one that has a bigger delta, will lose value faster than the one I'm long. The one with the lower strike, the one with the smaller delta. So one is gaining value faster in my long option than my short. The other is losing value in my short option faster than my long. They're going to work the exact same way. So once the extrinsic value disappears, and all that is gone at expiration, the two options are really moving in accordance with their deltas. They're mimicking power to the stock. And if I have a long call spread where I have an option that I own with a longer delta than the option that I'm short, as the stock moves up, my long increases faster than my short, meaning I make money. If I was short the put spread, as the stock goes up, the deltas and the value of the put spread goes down. Why? Because my short option, my short put, is losing value faster than my long put, the out-of-the-money one. By losing value faster, I make money as the stock goes up. So when are we going to use this bull spread? Well, right off the bat, the first thing that should hit you right in the face is that. It's a bull spread. What do you think we're going to use it for? How about a bullish movement in the stock? When we feel the stock is going to go up. Looking for an upward movement in the stock is when we use a bull spread. Now, you might say, well, what separates the bull spread from stock replacement? Why wouldn't I just want to do stock replacement? Well, the bull spread allows for what? The ability to collect premium. I have the ability to collect premium in the bull spread. I don't in stock replacement. I also have a higher probability of success because of that with the bull spread. Both will make money if the stock goes up. The stock replacement has an unlimited potential gain. The bull spread doesn't. But the bull spread has a higher probability of success because it collects premium. On another time is when the stock is expensive. If we're dealing with like a Google, the in-the-money call that I would need to buy for stock replacement could be as probably more than most stocks would be. It might be $60 or $70. That's still like buying an expensive stock. Depending on the stock and the value of that stock, the expensiveness of it, it might still not allow us to even do the stock replacement strategy without having to spend a ton of money. The bull spread is going to be much, much, much less expensive. allowing us to at least play an upward movement in a stock that we couldn't even afford to do a stock replacement strategy in. And finally, when we're in high volatility situations, we want to favor the bull spread when we're in a higher vol situation. Remember, if we have to buy our stock replacement call and volatility is real high, we would have to go very far in the money to find an option that has 85 deltas and very little extrinsic value. Going far in the money means we're going to have to spend more dollars. If that suddenly gets cost prohibitive, and we say, I can't even afford to buy the stock replacement option, you can turn to the bull spread. High volatility situations benefit certain bull spreads. One of them in particular is that debit spread, where you buy the long call vertical. When that happens, the value of these spreads crunches. When vol goes up, remember that Trumpification process? The value of the spread crunches. It almost makes it a little bit of an aberration where the value of the spread is actually looking and trading cheaper than it should be. That benefits us in the bull spread, because as time goes by, when vol comes down and theta hits it, our bull spread is going to open up, allowing us to make money. Or in the case of the out of the money short put spread, the other bull spread, remember that short put spread? If we do that one out of the money, that one's going to look wider than it is, and that way it closes down and gets further along in terms of profitability. If I get to sell it at $1 under normal conditions, that put spread, I might be able to sell it at $1.50 in a high volatility situation, giving me more to collect because volatility is so high. The right, properly constructed bull spread can benefit as volatility comes down. Now let's take a look at some charts. What we're going to do is we're going to look for patterns that are, shall we say, friendly to the bull spread. When we see these types of patterns that Chris is going to show us, we'll know that that is the pattern that we should see when we're thinking about a bull spread.
Ron.
Yes.
I'm blown away. That was incredible.
Well, thank you very much.
You did an excellent job.
I was practicing that one for a while because I knew that, the bull spread is one of your favorite strategies. And it was kind of a surprise to,
to do so well.
Oh, yes.
It was a surprise.
I'm sure you were surprised.
Yes, that you did so well.
Every once in a while I get lucky.
Can you do it again?
Actually, I am going to do it again in a few moments when we talk about the bear spread, which is the bull spread in the other direction.
All right.
But what we need now is we need something from you.
What's that?
Oh, boy. What we need from you is we need you to find the technical patterns that we would sit there and look at and say, you know what, this type of situation, that is where I want to put on a bull spread.
Okay, so what you need to see is a short-term uptrend?
I need to see exactly that, a short-term uptrend.
Okay.
Can you find one for me?
I have one already picked out in mind, and I'm going to show it to you. I'm going to show you how to identify it, and I'm going to show you how to take advantage of it.
That's what I want to see.
It's pretty basic stuff. It's pretty easy.
Well, when it comes down to it, you don't have to make this real hard.
I do all the easy stuff here.
I appreciate that.
Yeah. Technical analysis.
The old keep it simple.
Yeah.
Smarty
Silly.
pants.
Yeah.
I got to get
Smarty
that silly
pants.
smart pants. But yeah, I mean, you want to try to, when you're investing, you're not a floor trader. You don't have to sit there and get into all these different exotic things and get crazy with stuff. You keep it smart, you keep it simple, you keep it quick, you keep it efficient, and the technical analysis should be the same way. Okay. Smart, quick, easy technical analysis, throw on an easy, simple strategy.
Well, once you identify the key price points on a chart, it becomes fairly easy to identify what's going to happen next.
Well, you know what? Quit talking about it and show it to us.
All right. I'll see you in about 5 minutes.
Don't threaten me.
So if you're initiating a bull spread, that means that you're bullish on the stock. And what you're going to look for is a slow grinding uptrend, and preferably one that's a little bit shorter term in nature too. So a short term or possibly intermediate term. Short term is days to weeks, intermediate is weeks to months. Now let's take a quick look here at 3M. You can see that like many stocks, 3M bottomed out in March of 2009 here. And you can see that what we did was we took one low and we connected it to the next low and extended it out further to try to find an uptrend line. Now, just remember, an official uptrend line is after the first resistance level is penetrated to the upside. So you can see just because it landed here we made a higher low, and it started to bounce off. It's not officially a trend line yet. It's a tentative trend line at that point. Once it breaks through this level, it's officially a trend line, and you know that you have an uptrend on your hands. Now, the more that this trend line is touched, tested, and then bounced off of, the stronger of a trend line we're going to consider that to be. Now, there's other things that you can't see here that I just want you to remember because, again, you have to take a synergistic approach when analyzing a stock's performance. You could see here that the stock bounced. Looks like at about $55 a share. You could see that happened again here. This is no coincidence that it keeps bouncing off of these levels. What you can't see here is a descending triangle, and then it breaks right here. And always keep the key price points in mind, even if they happened a year ago. Because you can see here the stock bumped up, and it bumped up on huge volume. It took a lot of volume. It took a lot of buying pressure to push the stock back above 55 right here. And you can see that dates all the way back to before November. You can see in October this was a major point of support. Support again. Finally it cracked. And once it cracked through that level here, it tried to come up for some air. Bears knew that this is one of the stocks that they should be shorting. So they pushed the stock down here, and you keep all these levels in mind. Here's another point of support. You can tell it took a lot to get through that over here. So these are all key price points that all the traders in the stock are keeping in mind. Technical analysis is real. It's not voodoo. Okay, so you see that the trend line's up. A trend line is a support level. You can see that we bounce off of it and confirm it several times. And if you look at the volume, because you want to confirm that the uptrend has some validity to it, you can see the green bars are much bigger than most of these red bars here. You can see the up volume is stronger than the down volume. That implies that the down volume isn't so much there because there's so many sellers putting a lot of pressure on the stock by selling it, but instead because buyers decided to stop buying for a little while, take a step back, see how far the stock pulls back. Because remember, buyers want to buy the stock when it's low, and sellers obviously want to sell when it's high. So buyers buying it, they push the stock up. So they take a step back, and they say, let's see how far this thing pulls back so we can buy it a little bit cheaper. They stop buying. It's not that so many sellers come in and nail the stock down, and that's why there's not a lot of downside volume. The downside volume is light, the upside volume is strong. Always remember to keep your key price points in mind. So when you do that, you can see why sometimes it takes heavier volume to push the stock through those key price points. Now here's the uptrend line. You can see what happened here. The uptrend line was actually violated for a few days. So the first thing that we want to look at when a trend line is violated is we want to look at the validity. So we look at the volume. Now, this is kind of a subjective rule because you can be aggressive or you can be more conservative. A more conservative trader would see that this uptrend line is broken, then they might exit the position. But if you're a little bit more aggressive, what people do a lot of times with trend lines is they give it a little bit of leeway, maybe 1% or maybe 1.5%. Some people are very quick to sell. Then they're going to miss the continued upside. Other people are more conservative and say, you know what, I'll miss the continued upside. At least I'll be safe. You have to decide for yourself if you're the more aggressive trader or the more conservative trader. So what happens is the uptrend line is violated on the downside, as you can see here. But then obviously it continued higher. Hindsight's a wonderful thing. So what we do then, this is a tentative trend line. It's an uptrend line only after this point is broken. So you can see the stock moved higher, tested this level. This is the first time that it pulled back this far. So we draw a new trend line. That's the blue line. It's not officially a trend line. It's tentative. Only when this happens, only when this support level that I created right here at 55, once that's broken, then we can consider this an uptrend line. And we're going to extend that out further, and we're going to see eventually that's violated too. So you have one trend line that was violated and a second trend line that was violated. Okay, so when you're going to initiate your bull spread is after you see that this is officially an uptrend line. Remember, it's not officially an uptrend line until it breaks through this point of resistance right here. You can see this point of resistance was also the support level here. The support level here, it cracked through, had some trouble right here, became a resistance level, horizontally we're talking about. So we found this low, we connected it to the following low. It's not officially a trend line until we break through that resistance level that goes all the way back over here. Now it's an official uptrend line. Now the opportune time to enter your bull spread is when we pull back to the trend line again. When we pull back to the trend line again, since it had been tested and since it's an official trend line, it's highly likely that it's going to continue higher after bouncing off of this trend line. So this is where you're going to enter your bull spread. The goal is obviously to ride it up. So if you're the more aggressive trader, you might forgive this violation of the uptrend line. You might draw a new tentative trend line, and once you see that that resistance level here at 55 is penetrated to the upside, that's an official trend line, and hopefully you hold on to it. Now remember, 55 is still a key point. Once you broke through it, instead of being a key resistance level, it's now a key support level. You can see it bounced off of 55 over here. But what you got here is a MACD sell signal. You have an RSI sell signal because the RSI went above 70 and then started moving below 70, so that's an RSI sell signal. So you have all these red flags, RSI sell signal, you have a MACD sell signal. Now might be the best time to exit your bull spread.
To see how Ron selects options that match Chris's strategy, visit the member section at optionsgps.com.
Well, you made it look very easy. I mean, trying to find a short-term uptrend for a bull spread, that was perfect.
Well, you know, when it comes down to technical analysis, everybody just has to remember that a chart is just a picture of human emotion. It's just records. It's history of what led up to this point, how people felt about different price points leading up to the point that you're at. Once you figure that out, then you've pretty much got it covered as long as they know which strategies to implement based on what they see.
Well, that's why it's important to have so many strategies that you're comfortable with. We're not just teaching one or two strategies here. We're teaching them all of them because depending on the situation, a different strategy might be optimal, one might not fit at all. You have to be able to be comfortable with a lot of different strategies because the opportunities are all different. That means different strategies. And I've always noticed that, you know, when I was just starting out and was comfortable with one strategy over another, I would always look at that chart and all of a sudden my mind would start bending that chart in a way that would now be what I want to see.
Right.
Because I only know one strategy.
Right. So it would be like looking at clouds to see what it is that you want.
Exactly. You know, we sit there and we force the clouds to bend in shapes and we look for things that aren't there.
Yeah.
If we know all the strategies, then we can go look at the chart and let the chart tell us something,
right,
as opposed to us knowing one strategy and trying to have the chart be what we want it to be, which is a lot different.
There's two ways of avoiding that. Number one, remember, you're not looking at a chart and having a chart tell you exactly what's going on. I mean, in reality, it's the market. It's just a picture of the market. So you're letting the market tell you. People are casting votes every time they make a trade. If the stock is moving higher, it's because more money is going into the stock. So, you know, what you're looking at when you're looking at a chart is just the picture of human emotion and human nature repeats itself over and over and over again, which is what makes charts predictable. And understanding technical analysis makes you identify the high probability outcomes when they're in front of you.
And the thing about, you know, human emotion is that it changes. As time goes by, people are happy, people are sad, people are nervous. And with that, the pattern of the stock changes. And when that changes, the strategy that you have on, in this case we're talking about a bull spread, might not any longer be the right one. I mean, we might need to change that strategy. So what we have to do is we have to know how to morph it and turn it around and spin it around in case a situation comes where the pattern changes and we're in our bull spread.
Right. So, I mean, as I was going to say before, though, you know, the two ways to change the situation where you're looking at basically a cloud that looks like whatever you want it to look like is, number one, to understand all the strategies in and out, because you don't have to try to always fit a square peg into a round hole, so to speak. And the second thing is to really have a very good understanding of technical analysis and why things are happening when they are happening. That way you won't look at a chart and the chart won't look the way you want it to. When I look at a chart immediately, all these different key things on the chart immediately pop up, and any other good technical analyst will see exactly the same things pop up at the same time. So when you have a good understanding of technical analysis and you have a really good understanding of which strategies fit which chart patterns, then that's when you're on fire.
And having all those different strategies, I've heard an analogy. It's kind of like a carpenter. If a carpenter went to work with only one tool, and that tool is a hammer, pretty soon everything starts to look like a nail. So we want to not be that carpenter. We want to be the guy that's got all the tools, so that way no matter what the job is, we've got the right tool for it. And with that, we also know that as things change, we change. Our strategy should always reflect our opinion of what's happening.
Well, there's going to be times, obviously, when the stock moves. Every now and then that happens, right?
Sure.
Sometimes time even passes, right?
That happens.
And another variable that affects the price of an option, volatility increases and decreases, meaning there's a change in fear or complacency, which tends to happen sometimes, right?
Exactly.
So what we're going to talk about next is rolling and morphing in your bull spreads. So go ahead and go roll around in the bull spreads and show us what you got.
I'm going to go roll in the bull spread there. Okay, now that we had Chris show us how we find an uptrend, if we did find an uptrend, we now have decided that we're going to put on a bull spread. Why did we choose the bull spread? Well, we know that maybe volatility was high, and we know that higher volatility might eliminate the stock replacement strategy and push us toward the bull spread. Maybe premium collection is our thing and we want to use the bull spread. But either way, we were looking for that slow grinding uptrend. We found it, and now we're going to set up the bull spread. First, we have a choice to make. We can either buy the call spread or we can sell the put spread. Let's first look at the call spread, the bull call spread. We know that's a debit trade. It's a debit trade. We're going to paying money for this. We're going to buy one call, and then we're going to sell another call with a higher strike in the same month in a 1-to-1 ratio. So for instance, say we bought the 25 strike. We now own the 25 call. Our next move would be to sell a strike that's higher, the 30 strike. We buy the 25, sell the 30. Same month in a 1-to-1 ratio, we're now in the bull call spread. Let's decide that you didn't want to do the bull call spread and you wanted to do the bull put spread. That's a credit trade. The bull put spread will work the same way as the corresponding bull call spread. We know these two trades are identical. It's just a matter of which one you want to do as determined by the box. Now, if the box says everything's in line, then it's up to your personal preference. Do which one you want to do. So let's decide that the box was in line and you just wanted to do the credit spread. You wanted to do the bull put spread. You're going to buy one put, then you're going to sell another put with a higher strike in the same month in a 1-to-1 ratio. So let's just say that we bought the 25 put. Now we have to sell another put with a higher strike, say the 30 put. How are we? We're in the same month. We're in different strikes. We're in a 1-to-1 ratio. We have sold the 30 put. We've bought the 25 put. We're in a bull put spread. So let's take a look at a bull call spread example. Buying one May 90 call, selling one May 95 call. We are buying the lower strike, selling the upper strike in our call spread here. It's in a 1-to-1 ratio. Both months are May. Two different strikes. Looks pretty good. We're buying the May 90 call for $7. We're selling the May 95 call for $4. What do we know about the maximum value of this spread? What's the most this spread can be worth at any given time? $5, right? Difference between the two strikes. And we are paying what? We're paying $7 for the May 90s, getting $4 as a credit to us in the May 95s. We are spending money here. This is a debit trade. We're putting out $3. Bull call spreads are debit trades. It's the debit side of the bull spreads. What's our maximum gain? The difference between the two strikes, $5, minus what we paid. We paid how much? $3. What's the maximum value of the spread? $5. If we paid $3 and it's now worth $5, what did we make? $2. Our maximum gain is $2. What's our break even? We said that the break even for our bull call spread will be to take the lower strike call and add the amount of value of the spread. We paid $3 for this spread. The lower strike is 90. 90 plus 3 is 93. How are we sure that that is an accurate break even? Well, let's set the stock to 95, the point of maximum value of this spread at expiration. If the stock was at 95 at expiration, our 90 call would be worth $5. The 95 call with the stock priced directly at 95 would be worth $0. The spread would be worth $5. That's our maximum value. To figure out the break even now, all we have to do is say, okay, 90 plus the value of the spread, 93. What if the stock closed at 93 on expiration? Well, the 95 call would be out of the money and worthless, wouldn't it, with the stock at 93? But the 90 call would be in the money with value. How much value? If the stock is at 93 and I own this 90 call at expiration, I have the right to buy something at 90 that's currently trading for 93. That means the 90 call will be worth $3. If the 90 call is worth $3 and the 95 call is worth $0, the value of the spread at expiration with the stock at 93 would be $3, the same amount we paid for the spread originally. We would have no profit, no loss. 93 is truly the break even for this spread. Maximum loss. Well, what kind of spread are we doing? We're doing a bull call spread. And we know that this is a debit trade. This is the debit side of the bull call spread. Well, what do we know about buying options? You can only lose what you spent. We spent 3 on this spread. What's the minimum value of the spread? 0, right? If the stock closed at the low strike, the strike that we're long, remember when you're an option buyer, you never want the stock to close at the strike of your long option. If the stock were to close at 90, the 95 call would most certainly be out of the money. But so would your 90 call. And if both of these strikes at expiration are worth 0, the spread would be worth 0. So the spread can go down to 0. You paid 3 for it. If you paid 3 and it's now worth 0, you lost $3. But that is your maximum loss. Let's take a look at our bull put example. We're going to buy one May 90 put for $2 and sell one May 95 put for $4. Here we see that what do we have? We're buying the lower strike, selling the higher strike. The higher strike is worth more. It's worth $4. We're going to be bringing in $4. The lower strike isn't worth as much. It's only worth $2. We're putting 2 out, bringing in 4. Putting out 2, that's going to give us a $2 credit. This bull put trade is the credit side of the bull spread. Now, what is the maximum value of the spread? $5. How much did we pay for it? We didn't pay for it. We're taking a credit in. We have a $2 credit here. What does that mean our maximum potential gain can be? If we sold this for 2, the most we can make is 2. Once this spread goes to 0 and has 0 value at expiration, the value of the spread being 0, we sold it for 2, we made 2. What about our break even? We said that with a bull spread, the bull put spread, our break even will be determined by taking the higher strike and subtracting our credit. The higher strike is the May 95s. We received a $2 credit to do this trade. 95 minus 2 is what? 93. That just happens to be the same break even as our long call spread that we just did. It has to be. These two positions are synthetically identical. Buying the call spread versus selling your corresponding put spread. They have to have the break-evens equal if they are truly identical. Let's see. What if the stock closes at 90 at the lower strike at expiration? Both options would be worth 0, right? Okay. What if the stock closed at 93 at expiration? Well, our 90 put would be out of the money, right? Worthless. But the 95 put, the right to sell the stock at 95, would have value, wouldn't it? Because the stock's only trading for 93. I could go out in the open market, buy the stock for 93, exercise my put, giving me the right to sell it for 95. I would have a $2 value there. So at 93, the 95 put would be worth 2. The 90 put would be worth 0. The value of the spread would be 2. The same spread I sold it to. It's worth 2. I sold it at 2. There's no profit, no loss. 93 is truly our break even here. What's our maximum loss? Well, we sold the spread for 2. We know that the maximum value of the spread is 5. If we sold it for 2 and it can go to 5, we could lose $3. Simple. Now, if you look at this bottom part here on this slide and go back to the previous slide and look at the bottom part there, you'll notice that in both these examples, the bull call spread and its corresponding bull put spread, the maximum gain, break even, and maximum loss are identical. And on top of that, each of these occurs at the exact same price in the stock. They are synthetic. Buying the call spread is the same thing as selling the corresponding put spread. That means that if I buy the call spread for 3, remember we bought the call spread for 3? If I buy it at 3, I can lose 3. If I sell the put spread at 2, I can lose 3. 3 and 2 is what? 5. These are synthetically identical positions. It's just a matter of which one you want to do or which one that the box indicates is out of line, which could potentially give you a little bit of edge by doing one instead of the other. What are my keys to success here? Obviously, this is a directional trade. It's called a bull spread. We need the stock to go up. If that's true, we need to find a stock that's probably going to go up. We need sound technical and fundamental analysis of the underlying stock first. We also have to understand that premium collection has nothing to do with debit and credit. I'm sure some of you have taken classes from other people and you've been told that credit spreads are premium collection spreads. That's not necessarily true. Only certain credit spreads are premium collection trades. You've probably also been told that a debit spread is a premium outlay. You're paying for it. But that's not necessarily true either. You might be paying for it, but that doesn't mean that it's not premium collection. Because you, who went through your Greeks first, understand that premium collection has nothing to do with debit and credit. It has to do with theta. And I can create a debit trade with a positive theta. How do I do that? Buy the in the money and sell the at the money. Remember, the at the money option always has the highest theta. If I'm short the at the money option, then my positive theta will be greater than the in the money option I buy. That spread will make money with the passage of time, even though it's a debit. The key here is to understand that premium collection has nothing to do with debit and credit. It has to do with theta. When you're doing your bull spread, if you're always selling the at the money option, whether you buy the call spread or whether you sell the put spread, if you're short that at the money or you're short the strike closest to the at the money, then you're going to be in a premium collection trade. Whether it's debit or credit, doesn't matter. Know that buying the call spread is the same exact thing as selling the corresponding put spread. And you know that the two have to be related in price. You know that the call spread and the put spread combined, their combined value, must equal the difference between the two strikes. If they're both identical in what they are and do, and one is cost effectively higher than the other, then you have advantages to both entering and exiting. Enter long through the cheaper one, exit short through the most expensive one, and vice versa. So let's talk about trading the bull spread here. Because now that we've got our bull spread on, we have to start looking at the movement. What are we going to do to manage this position? Well, what if the stock goes up? What do we got if the stock goes up? Well, the stock going up can always allow us room for a roll. But remember, if you roll your short strike, what winds up happening is that you put yourself into a new spread, a wider spread. And the wider the spread, the more risk. Remember, you're going to read in the textbooks that you can roll up that short option. But when you do, you're adding more risk. We want to be taking risk off the table, not adding it. So as far as potential rolls, I say no. Because if I'm going to have to roll my short option, the long option has to go with it. That's 2 trades anyway. If I'm going to make 2 trades, take the bull spread off completely, take your profit, sit back, have a beer, take a deep breath, and reevaluate. If I've got to make 2 trades anyway to roll this properly, I might as well shut it down and reevaluate with a clear head. So really, morphing is what comes to play here. But if the stock is going up, should I change anything? I mean, it's a bull spread. The stock going up benefits me. But the stock going up benefits me if it's a nice, slow, grinding, trending movement. What happens if during that uptrend, we hit the resistance of the upper end of the range and we break through it? Now, we're no longer in an uptrend, are we? We're in something that's called a technical breakout. And although our bull spread will have made us money, it's also limited. And here we are, limited upside potential in a stock that's about to have a 3 to 8 day run, 10 to 15% in value. I don't want to be limited. What am I going to do? I'm going to morph my bull spread. Even though it's in the right direction, even though it's profitable, I have to remove my limited risk, my limited reward potential. And I can always close and reestablish later. That's what I was talking about. The roll isn't important anymore. I don't roll vertical spreads. Why? Because I'd have to roll 2 separate options. If I've got to make 2 trades anyway, I'm going to be literally shutting one down, one of my verticals, and opening a new one. If I've got to do that, then let's just close the doggone thing, take a new look at the stock, and reestablish. So first, here's our bull spread. Let's take a look at the first roll. There are no rolls, right? We're not rolling. But what we can do is go into a stock replacement strategy. How did we do that? Very simply. We start off with our bull spread. The stock is running up. Now that the stock is running up, we say, oh my gosh, it's about to break right through the resistance. Boom, it breaks through resistance. We're no longer in an uptrend. We're now in a breakout. And the bull spread is not the optimal strategy for the breakout. Did we make money? Yes, we did. Did we optimize? No, we didn't. We need to change our bull spread. So here we are in the bull call spread. Stock is running up. Which one of these options is hurting us? Which one is limiting our potential? Which one is stopping us from being all that we can be? The short call. What do? Simply buy it back. Now that we've bought it back, we're in this stock replacement. Now we have our unlimited potential reward to the upside, and this call is following the run of the stock on the breakout. And what do? We always remember to roll. We roll right up with that breakout. So what we had was we had a bull spread that was hurting us due to its limited profit potential. When the stock took off, our bull spread would maximize and then stop with the stock running. We want to get out of that position. We want to buy back our short call and ride the long call in stock replacement fashion. But remember, roll, roll, roll. What if we were in the bull put spread and that happened? The stock is going up. That's wonderful. We're making money in our bull put spread. We're short the put spread. We're doing fine. But the stock now breaks through resistance. It's now a breakout. And we're sitting there saying, oh man, I'm limited in my profit potential here. And the stock is breaking out. I could be making more money. I could be optimizing my position, but I've got a bull spread on. What am I going to do? Well, which option is hurting us here? The long put is hurting us here. But we have a little bit of a problem. See, that long put which is hurting us, if we sold that one out, what would we be left with? A naked short option. And we know my rules. If you are caught by me naked short an option, then what I'm going to do is I'm going to hop on a plane, fly to the city you live in, rent a car from Hertz, drive to your house, set your hair on fire, and put it out with a baseball bat. You want to know why? Because you deserve it. This type of position, that short naked option, is the type of position that eliminates people's portfolios. Individual investors don't lose money trade after trade after trade after trade. They normally make a little money trade after trade after trade. What hurts them is the one big, catastrophic, unexpected loss. That's where they get killed. If we can eliminate that, you're going to stay in the game long enough to take all these things we're teaching you and learn how to practically apply them to make money. But it takes a little while. If we can eliminate you getting blown out before that, then you're going to have success. We can't be short naked an option. So what are we going to do? We're going to turn to our understanding of synthetics and do something different. We're going to go to that short put strike, and we're going to buy the corresponding call in a 1-to-1 ratio, not way. 1-to-1 ratio. What happens here? Look, suddenly, if I look just at my 70 strike, what do I have? Long call, short put, 1-to-1 ratio, same month in strike. That's long stock. The 70 strike, although having a call and put, is now really a long stock. I have long stock, and what remains? My long 65 put. Long synthetic stock plus long the 65 put gives me long the 65 call. Simply by buying this call here, I have changed my long June 65 put into a long June 65 call with the stock breaking out to the upside. That's how we play this the smart way. This way, we're not caught short a naked option. This way, we don't watch our entire portfolio and whatever else we make in our life disappear because we owe it to our broker because we just lost 170 grand on some stupid stock that we were short a put on that opened up one day at zero. We can't afford that. This is what we do. We buy that call, setting up a long synthetic stock position, teamed with my long remaining put, long the synthetic call with the stock running up. This is why synthetics is important. What if the stock goes down? Well, that kind of happens every once in a while, doesn't it? We're sitting here, we're in our bull spread, we want the stock to go up, it goes down. What are we going to do? Well, we don't like rolling losing positions. Remember, rolling is really a continuation strategy. It's more of a strategy that basically says, hey, things are working, things are good, things are continuing, I want to continue with my position. I am going to roll. Well, here, what's happening? Things aren't good. The stock is going against me now. I'm losing money. I want to stop losing money in the up direction and turn around and get into the down direction. I have potential morphs here. My debit trade, the long call spread, I'm going to change that into a synthetic put, just like I changed that last one into a synthetic call. My credit spread, I'm going to change that into stock replacement. And remember, if things are going against you, you can always close out. Just remember you've got more than one way to close, and one way over the other might be a little more cost effective for you. Well, let's take a look at how we actually adjust these positions. Say we're in the bull call spread, expecting the stock to go up. It turns around and goes down on us. What can we do? Well, not a whole heck of a lot we can do, but there is one thing that should work for us. Remember, it's our long call that's hurting us right now, right? As the stock's going down, it's the long call that hurts. We can't just sell that out because it's going to leave us with what? I don't know if you have a fire extinguisher and some type of baseball helmet, but you better get one if you do that. We have to leave the long call intact. We can't be naked short this call here. So what can we do? Go back to synthetics. Take the short call's corresponding put and buy it. When we do that, we create a situation in the 70 strike where we're long put, short call. What is that? Long put, short call equals short stock. We're short synthetic stock plus this call, that long call that remains. Short synthetic stock, long call, that's a synthetic put. We've just changed our bull call spread into a synthetic put when the stock started going down against us. One quick trade, buy the short call's corresponding put, and you're in a synthetic put now, making money as the stock goes down instead of being stuck in your bull call spread, losing money as the stock goes down. What if we were in our bull put spread and the stock went down? Little bit of an easier morph here. Which option is hurting us now that the stock is going down? It's going to be the short put, isn't it? The short put is hurting us. That one we can buy back because it would leave us simply with a long stock replacement put. So we buy that one back, and what do we have? We have a long stock replacement put. With the stock trading down, we just roll right on down with it. So those are our two morphs if the stock decided to go against us. We can always close out. If things aren't working out the way you thought, you could always close out. Let's say we're in the bull call spread. Remember, we could just simply sell this call spread out, can't we? We could simply buy back our June 70, sell out our June 65. Or, being long the bull call spread, we could buy the corresponding put spread. What does it set up? Look at our synthetics again. Long call, short put is long stock. Short call, long put is short stock. We've just placed our long bull call spread into a box by simply buying the short call's corresponding put and selling the long call's corresponding put. Long bull call, we added long bear put. We neutralize the position. If we're in the bull put spread and next thing you know the stock is going against us and we're not feeling it. We know we can morph it, but we just can't do it. Our head's messed up. It's not working. We're upset. We can always just close. We can sell out our long put and buy back our short put. That would close the position. But depending on the value of the spreads based upon the box, we might want to turn around and sell the call spread. What does that give us? Long call, short put, that's long stock. Short call, long put, that's short stock. Long stock, short stock, cancel each other out. We can close in two different ways our bull spreads. Now, what if the stock stays still? What are we going to do? Well, should we roll it? Well, you know what? If the stock's not moving and we have our spread set up as a premium collector, meaning we're short the at-the-money option, we're going to be collecting premium. Leave the spread alone. It's fine. As long as the stock stays still, we have premium collection ability. We're in good shape. We don't move. Does it matter whether it's debit or credit? No, because premium collection has nothing to do with debit or credit. Premium collection is all about theta, and theta is biggest at the money. If we're in a debit spread and our short option is the at the money, it's a premium collector. If we're in a credit spread and our short option is the at the money, it's a premium collector. If the stock stays still, we're making money through the collection of premium. leave it alone. What about morphs? Well, if we really have changed our opinion on the stock and we say, hey, I thought the stock was going to go up and it looks like it's now consolidating here, we can morph our bull spread into a butterfly or a condor. Closing alternatives. Well, you know what? It's not hurting us. It's making us money. If it's doing the right thing, why are we going to change it? We don't want to. Leave the spread alone. Let it collect premium. So here we are in our bull call spread. Suddenly we feel the stock is now going to consolidate. Look what we can do. We can go to the two next higher strikes. Sell the 70 strike, buy the 75. So we have a formation here of long call, short call, long call. That right there is a condor, a delta neutral, very powerful premium collector. If the stock is going to stay sideways to a point where we've changed our position in the idea of it's not going up, then let's change our real position. Let's have our strategy match our opinion. Hey, I thought it was going to go up, and now I'm looking at it, it's going sideways. Don't stay in the bull call if we think it's a longer-term sideways movement. Let's get into a condor and really collect premium. All we have to do is go to the next two strikes and sell that call spread. And we're in a condor. What if we were in the bull put spread? How do we do it? It's going to be the same thing. We thought the stock was going to go up. It didn't. It went sideways. We waited for a little while and we said, wow, not only is it going sideways now, it looks like it's going to continue this movement for a while. This bull put spread's not hurting me, but in a consolidation mode, we want to be a stronger premium collector. It's collecting a little, but it could be collecting a lot more. What can I do? Go to the next put spread and buy it. When we do that, we set up that plus, minus, minus, plus position again. A condor. We're now in a put condor, which is synthetically the same as the call condor I just showed you. But what we are in now is a delta neutral, very powerful premium collector. So if we feel while we're in our bull spread that, you know what, this consolidation might be a lasting thing, let's get out of our bull spread and let's either get into the call condor if we're long the vertical call spread, or let's get into our put condor if we're short the vertical put spread. Well, that's it for now on vertical spreads. Do understand that these things, although extremely flexible, although extremely powerful, are a little more sophisticated. So you're probably going to have to do a little more homework. But if you're an individual investor and you want to be able to trade everything, every stock at whatever price, you want to trade high vol, you want to have premium collection ability, you want to be able to have limited risk and limited reward, but still have a very good percentage return, then you're probably going to need to look at the vertical spreads, including the bull spread.
All right, Ron, you really laced that one. You really knocked it out of the box. Good job. Good boy. He loves when I say that. Anyway, we're going to close the bull spread. Now you have a pretty good idea of how to use the vertical spread to make money when stocks are advancing. But if you're like me and just about every smart trader I know, you want to also make money when stocks decline. So we're going to hit the bear spread next. Before you hit the bear spread next and you pop in the next DVD, go to the community, optionsgps.com. Please pass this quiz before you move on. If you don't pass, take the material again and then take the quiz again. In any case, I'll see you when you pop in the bear spread DVD. See you there.